Peter Rose, Longwood Currency Trading. It's about early February to mid-February 2022. Kind of a warm winter day for February in New England. And so as I entered the day today, looking at hauling in a bunch of wood for the wood stove, I was thinking about an issue that I've been writing about in one of the courses that I'm working on how to look at trade entry. And this is really the critical thing behind trading. If you get your entry wrong, you're screwed. If you're ever going to lose any money, it's at your entry. You're not going to lose it once you've moved your stop and you're into the position management stage of the thing, unless you just don't understand how to protect your thing, or there's no reason for you to lose any money after you've gone into your trade successfully. You can at least break even on any trade once it's gone far enough that normal gyrations of the price wouldn't take you out just on too close of a stop. But the important thing is looking at your win-to-loss ratio to determine the success of your trade entry. Now, I just got done watching a video from a pro trader. They've been out there with videos and courses for a gazillion years. Pooped all over the win-loss ratio. They call it a win rate. It's not a win rate. It's a win-to-loss ratio. Win rate is different. But they're talking about win to loss. Well, if you won 9 times in a row and lost once, you'd have a 90% win rate, win-to-loss ratio. But you could still lose money because you could win $10 each time you won and lose $100 each time, the one time that you lost, and you'd be 10 points down. So it doesn't mean anything. And their conclusion was it was your risk to reward ratio. If you've heard me before rail on about the stupidity of anybody who talks about risk to reward ratio, I'm sure you're bored to death to tears about it. And first of all, let me just clarify so you don't think I'm an idiot. It's not risk to reward ratio, it's reward to risk. That's how it's presented, that's how it should be stated. Oh my God in heaven. And it's the stupidest thing that I've ever heard. In any event, to juxtapose the importance of win-loss ratio with the stupidity of reward to risk is just beyond comprehension for someone who is successful in their trading. I'm sure they are. They're well known. But they're not expressing it. Again, it's my position. There's a lot of people that are successful out there, but they really don't understand how they got successful. And so they push it off on stuff that's related to they're the results of your success. They're not the cause of it. Let's put it that way. Okay, I think you understand that. And it's unfortunate because there's a lot of really talented educators out there that have so much that they can share, with us, but they don't get it. They don't see the dog for the tail. And so regardless of all that, we all agree that how you look at your trade entry is really the deciding factor in whether you're going to be successful or not. I think the win-to-loss ratio is a good indicator of that, because if you're losing a lot, then you are winning the number of times, or if you want to do it on a dollar value, you can do it that way. But what does that indicate? Well, how many variables for loss are there in a currency trade? So I've solved that problem by simply limiting my loss to the trade entry. So when I say I have a win-to-loss ratio of X, it's because I've taken care of that of that loss component up front when I'm not delusional and caught up in my long-term survival real estate investment mode that I was in for 40 years. And I've expressed the problems that I'm having breaking those survival characteristics and habits from 40 years of real estate and mapping those. They're not mapped directly into the currency trading. I know what that mapping should be, but it's just very difficult from an emotional standpoint when in real estate you spend 40 years playing the long game, and in currency trading, it's my belief that you're much safer playing the short game, doing day trading and being flat at the end of the day. I mean, the last, I don't know, a couple of videos that I've done over the last 3 videos over the last 10 or so that I've done, I've been talking about volatility. I've been talking about pin bars and all that other stuff. You know, what do you want to do? You want to get caught with that stuff during the night? You're managing your trade by trailing your stop a certain position point below where it's supposed to be, and it takes you out. But then your risk up front is not paying you for the time you've been involved in the trade. This has nothing to do with risk reward. It has to do with getting paid for the time that you're in the trade. So you can have a $2,000 account and have a $1,000 profit, but if it took a year, you've made, you did 50% on your account. You had a $2,000 account, you made $1,000, you made 50% on your account. But it took you 2 years. You had to hold that for 2 years. So you divide that $1,000 into by 100 weeks, let's say. But you're not getting paid for the time. When if you knew what you're doing as far as your trade entry, you could go in and I mean, you might not make $1,000 on a $2,000 account. It may take you that long, chipping away at it at 8 or 10 pips a day. You know, so let's say let's say the example I use is 5 pips a day. You do that 3 days a week. You got 15 pips. That's 60 pips a month. Well, if you're trading with any size, that's a lot of money. You know, if you have a $100,000 account, so you've got plenty of breathing room over the margin. You're trading at $100 a pip. You make $60. You know, that's a lot of money. Well, of course, you got to have $100,000 to do that. Well, that's what you can do, but you can't do anything if you don't get your entry right. If you don't get that price moving so that you don't get tagged out. Now, there's some very competent traders out there that will say, well, it's always going to turn against you, and so therefore you have a get out of jail stop, let's say 20 points away. And so your expectation is you're going to stage in, you start with one lot at your entry point, and it goes a little bit in your favor, and you're looking for a long 20 points, say, to the profit end. And then it turns around and goes against you 5 or 6 pips. You buy another lot. You know, the price is going against you and you're buying a lot. You're averaging down. I mean, every trading dictum, rule, book master has always said, do not average down in your position. And you cannot average down in your position on a long-term scale because the consequences of that are catastrophic. If you have, instead of a 20 pip long stop, you have a 200 pip long stop, and you're staging in so that you staged in 20 or 30 lots over that period of time, if in fact you want to stage in your full position, and it doesn't, and it hits and it goes against you, the 200, I mean, it's just, I mean, it's $2,000 a lot. So when you look at this stuff, who are you watching this channel? You're not a bank trader. If you're a bank trader, you're doing it for entertainment or to see what the guys on the retail side are doing. I don't know. But you're a retail trader like I am. And so I think you'd be safer trading from the short side. You need to look at some of the other videos that I've done or blog posts, or write me an email and I can go over this stuff with you as to why I think it's better for us as retail traders to play the short game than it is to play the long game. And that's why I'm having such a problem with my timing, because I've got 40 years of survival instinct in this real estate. You don't buy a building to sell it in 6 months. Well, I mean, you could flip, but then you're doing short side flipping and trading, and the rules change. And at some point, you've put $300,000 into that property that you've bought for two, and you put 100 in, and you're going to sell it for 550, but nobody buys it, and the market goes down, and you've got 4 of those properties out there, and a partner, and you're screwed. There are ways to play that smartly. I certainly in my career have dealt with people that have been successful and have been able to get out when the turns come because they're sensitive to the market, or they just rent it and mitigate their risk. But that's difficult to do in the currency trading. I mean, it's something that you can't do in futures, for example, unless you want to roll that contract over into the next time frame. But look, it still comes back to the entry. If you're losing money, then it's one of two reasons. One is your entry is not good and you're getting stopped out. Or you don't fully understand the rules of position management and you're losing money when you shouldn't be losing money. The reflection is in your win-to-loss ratio and your average win. Those are the two numbers that I combine together that provide the juice for the win-to-loss ratio to make sense. Because if you have a negative average win, that really is very telling. It tells you something, right? And so you really have to journal your trades, and you really have to look at the metrics, and you have to do some math. It's simple arithmetic in order to develop some averages and some what was my max win? How many trades in a row did I have for winning trades, and how many trades in a row did I have for losing trades? What was my average win on the largest streak of winning trades versus the average loss on those streaks? Why did those streaks happen? Where were they? What was I doing when I hit the streak, or was it just a statistical anomaly that I was running into? That's why we journal. That's why we do that stuff, because you really need to study that entry that you're doing if you're losing money. And it might not be that you're losing money. You may be successful and you may be net profitable, but not to the level that you feel that you should be. So I've got two questions for you when somebody calls me and they go, well, what amount of money do you want to make the trading worth your while that will positively affect your lifestyle? I mean, if you're trading with a $3,000 mini lot, 3 minis, and you're trying to make $100 a day, can you do that at $3 a pip? No. It's going to be really difficult for you to do that. So what amount of money with your $3,000 would be significant for you? I mean, look, if you could pay let's say you pay your heating bill. I just had the oil guy who dropped oil for me. It's $413 or $415, something like that, for a full tank. And so if you could make $400 a month off a $1,000 account, that's a 40% return on that $1,000. Can you get a 40% return? I don't think so. Could you get a 20% return? Well, what would you need to do to get a 20% return? Well, you'd need a $2,000 account then, right? To make the $400 would be 2 on that. But can you get that? Well, you don't know. You have to balance these. You have to balance these numbers out. What would you need to make in order to, with an expectation on a $2,000 or $3,000 account, in order to say, well, if I had a $30,000 account or I had a $300,000 account, I'd be rolling in the juice. And so that's the thinking that you want to have. Not that I want to take this $3,000 account and double it in 4 months. Fuck you. Come on, really? You need to get serious. Or listen to these MyFX lifestyle asshole or whatever. I don't even know if he's out there pushing anymore. He doesn't trade, by the way. He doesn't trade. He doesn't make any money trading. He doesn't even know anything about trading except what some guy's telling him. And he sits there throwing his money around the millionaire lifestyle. He made $80,000 a few years ago, and none of it came from trading. It all came from courses and consulting. Man, you can get bamboozled out there. I know you want to make a lot of money. I know you want to take your $3,000 and make $10,000 a year so that you can quit your day job. Maybe your day job is paying you $20,000 a year, and you'd like to make $30,000 to up your thing. So, you'd like to make an extra $10,000 a year. Well, are you going to do that on a $10,000 account? Can you double a $10,000 account? Well, you need to be realistic. If you know what you're doing, if you're really, really, really good, and you have patience, you could double that $10,000 account. You could double that $3,000 account. But you really have to know what you're doing. So the question is, and not only do you have to know what you're doing, and I'm not talking about the information that you have, I mean, it's the experience. Your experience trading, your expectation for how this is all going to go together. And that the methodology that you're using has a good win-to-loss ratio and a good average win. I mean, that's the only way you're gonna know where you can push it in order to increase the amount of money that you're making. You have to start out not compounding. If you're compounding and you have less than a year or so of trading, and you're trading with less than a $20,000 or $30,000 account, don't even think about compounding, because you don't have you're not risking enough money to see what the consequences are when you make a mistake. And don't go to micro lots, and so don't take one mini lot and break those into 10 micro lots. If you want to take a $10,000 account and break that into 10 minis, that's fine. But if you don't have the experience of trading so that you get a good win-to-loss ratio and a good average win value with one mini lot over a substantial number of trades, I call it 200 or 300, because the first 100 or so, you don't know what you're doing, so you probably don't even want to add the first 100 in. It's the last 100 in the 300, or maybe you want to do 200 trades, and so the last 200 is what you're going to get your win-to-loss ratio. You need at least 100 trades. So if you're trading on a long-term frame, it's going to take you 10 years to get 100 trades. God almighty. If you want to trade long-term, learn your trading on a short-term scale. And then you can map that up. But if you make these mistakes up at the long-term trending, well, when I started to trade, I was doing the long-term stuff. I was mixing. I was even making a mistake. I was doing short-term and I was doing long-term. You know where I got clipped? The long-term trades. I got beat to shit. Learn your craft first. Become consistent so that you have an equity curve that doesn't vary more than, I don't know, if you trade the mini lot, the equivalent of maybe 10 pips either side of that. In other words, you on a daily basis or a trade basis, your expectation is to make 8 pips. So maybe one day you'll make 18 pips. Okay, and maybe on another day you'll go asleep and you'll lose 18 pips. So you want to have a very consistent band. It isn't, the equity curve isn't just a line. Okay, It isn't just a line, it's a zone, it's a band. If you don't have that, you can have a rising equity curve with deep spikes and losses and these enormous large gains, and those will cancel each other out to give you this nice average curve up. But if you're dropping 20% of your account a couple of times a year and making 30 or 40% a couple of times a year, do you really have the skill to weather that, to do that? Because what happens if you end up in one of these statistical long periods where you're going to lose? And so your equity curve is showing these 40 pip losses, or 50 or 60 pips, and you do that 10 times in a row. I've had 13 losing trades in a row in my career one time. 13 in a row. That's a lot of losing trades. Part of it was I was just being stupid like you normally would be. But the other, I just got caught in the statistics. And so you have to really watch this stuff. But before you can worry about any of that stuff, you've got to know how to do your trade entry. You've got to learn how to think about that trade entry. It's just really critical. And I'm just here to tell you that your success at that trade entry is not what this other person is talking about, accounting the risk to reward, God forbid, and saying that the win-to-loss ratio is minimal and don't even consider it. That's just craziness. There's no... I've got a degree in physics and almost a minor in math, and I spent 33 years as a software engineer. I think I know probability and statistics and what's possible and not, and what works and what doesn't work, far better than 99% of the people that are out there talking at you. Listen to me. Work to develop a good win-to-loss ratio with a great average win rate on a small account. Enjoy the losses, because each time you lose, you want to win. You just don't want to say, oh, damn, I didn't get that right. Analyze it and get your trade entry down. And once you get your trade entry down, now you're into position management because you're able to lock your profit to at least a break even, or 2 pips, or 3 pips, or whatever it is. And then just push that son of a bitch for all it's worth beyond that. But you have to be careful, because if you stage in too close, your average value comes up so much that then you get a spike down. It'll go through that average, and that's how you'll lose. But that's not understanding that position management work that you have to do. But unless you're successful to start with, you shouldn't be staging anyway. Oh man! But have a great day, huh? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day. And if you happen to like coffee, go get one and have one, because it's a great day.